Hi there everybody and welcome back to another stock analysis video. Today I would like to analyze again Alphabet Inc., otherwise known as Google, because it's been a while since I've analyzed this company, ever since I did the FANG videos, and I want to see if this company's ticker price actually matches its fundamentals. So let's see if anything has changed. And also the fact that, well, Google has been on the news recently these past couple days, mainly because of the fact that they beat earnings massively, and they also said that they are going to do a 20-to-1 stock split, which is massive. This is by far one of the biggest stock splits I've ever seen in my life, and it's just absolutely crazy. So I want to see how this company is going to look like after this 20-to-1 stock split also takes into effect, and well, what we should be paying with this 20-to-1 stock split in application. So with that said, let's get started with this analysis. Starting off, we got the calculator, ticker symbol of GOOG. Now, Google is one of those companies that has a Class A and a Class B. For all intents and purposes, I'm going to be analyzing Class A, which is GOOG. Class B is GOOGL, but just for all of you guys to know, they pretty much trade roughly the same, so doing one should give you a guidance as to the other one. Market cap of around $2 trillion with a T, guys, $2 trillion. PE of 28.51, which is just one metric. However, this one metric is telling me that this is very, very much overpriced. Because again, for me, I would like to buy anything under 20. 28.51, almost 30 PE is just massive to think about. Current share price almost reaching $3,000 at $2,960. Which is massive to think about. They did not pay a dividend, which means that all of this cash flow, this $37.5 billion in free cash flow within the past 5 years, is going into making acquisitions, paying down debt, and reinvesting in themselves. Now let's actually take a look at some metrics. We got the net income 5 years ago of $12.6 billion to 1 year ago of $76 billion, which is an increase, guys. Look at this increase, 500%. 500%. From 5 years ago to 1 year ago. And as you can see, this graph was steady up until 2 years ago, and then 1 year ago, boom, it just skyrocketed. I don't necessarily know why this is the case. It might be because of COVID, because a lot of people were at home, and Google was one of those companies that people just use, right? Google was one of those things that you could just use to be like COVID in my town, COVID cases in the United States, COVID cases in Switzerland, or whatever. So they really got a huge bump, and I think this is the reason why. Now, will they be able to do this? I don't necessarily know. Their earnings were very positive, so for all we know, my current year analysis might actually be way off. For all we know, the current year income might be my 3-year income projection. So again, these are just my assumptions, so it may be wrong, may be right. We will see how this actually goes. Next, we got the free cash flow, the lifeblood of the company, and just like the net income, we see a huge spike in the 1 year ago mark. 5 years ago, it was around $24 billion to 1 year ago of $67 billion, which is an increase of 180% in the free cash flow, with an average 5-year free cash flow of $37.5 billion. And guys, again, really smooth graph. Honestly, I might actually foresee that my projections here into the future might be correct, mainly because they're not too far off from the trend line. So we shall see, but nonetheless, a very positive metric when it comes to the free cash flow. Next, we got the revenue 5 years ago of $111 billion to 1 year ago of $258 billion, which is an increase, guys, of 132.41%. Another massive increase in another metric. And again, just as we saw with the free cash flow and income, a nice steady graph. In fact, in this one, we actually see even less of an increase when it comes to the 2 year ago mark to the 1 year ago mark. This seems a little bit more plausible, which means that, again, if this is actually true, if my assumptions into the future are true, then my assumptions here, my projected revenue, might actually come true or somewhere within the correct ballpark, which is really good to see. Next, we got the total assets minus the total liabilities. I added this metric because I wanted to find out if companies were actually able to pay down their total debt. Now, just showing debt doesn't necessarily mean anything. So what I did was I took the total assets and subtract the total liabilities, and this is the graph that we get. Currently, Google has a massive total assets minus total liabilities of $124 billion. This means, guys, if they were to liquidate all of their assets, they would pay down all their liabilities and still have $124 billion left in cash. Think about that number, $124 billion. That is absolutely massive to think about. They essentially don't even need to have debt at this point. I don't know why they do, but apparently they do, but they really don't need to at this point. Taking the total average assets, we get around $160.5 billion, and the total average liabilities is about $48 billion. And doing the assets minus the liabilities on the average scale, we get around $112.3 billion in the positive direction, which means that for the past 5 years and current year, they have been positive on their assets minus the total liabilities. Next, we got the shares outstanding, a metric that a lot of people tend to overlook. And you don't want to overlook this, guys, because this tells you whether or not the company is diluting you as the investor. You want this to be going down. Now, I need to make a disclosure here. Google actually doesn't have, for some reason, Google doesn't actually have the 2021 shares outstanding. In fact, looking at Seeking Alpha, we see right here, total common shares outstanding. We have the 2017 numbers, 2018 numbers, 2019 numbers, 2020, and nothing for 2021 and nothing for current. Now, I don't necessarily know why this is. I did do a little bit of research and found out that the current filing of shares is actually as of October 2021. So if this is measuring from December, clearly we're not going to get the December 2021 number because they still haven't reported it yet. So that's essentially why this isn't even complete. Now, my disclosure is that, well, since I already did Google in the past, I already did an analysis of Google in the past, I'm just going to be using these same shares outstanding, guys. I don't think there's going to be much difference from 1 year ago to today, so bear with me here. I'm sorry, I wish this was a little bit more accurate, but unfortunately it's not. It is what it is. But nonetheless, 5 years ago, we had 691 million shares to today, obviously today, air quotes, of 668 million shares, which is a decrease, a tiny decrease around 3.43%. Could be better, could be worse, but then again, a decrease is a decrease nonetheless. And lastly, we got the cash equivalents, and as of today, they have around $21 billion in cash equivalents, with an average cash equivalents of around $19 billion. Now let's actually make some assumptions, guys. We're going to make a low, median, and high assumption, changing the growth rate and keeping the required rate of return the same, around 10%, matching the market. Now, for the low assumption, I'm going to assume a growth rate of around 15%, which actually comes out to be a target share price of $1,200. For the median assumption, I'm going to assume a growth of 20%, and this comes out to be $1,405.71. And for the high assumption, I'm going to say a massive 25% growth, which comes out to be a target share price of $1,636. Now, we need to adjust for debt. Google honestly does not have a lot of debt, guys. They just really don't, which makes the target share price actually go up because they have more cash on hand than they do debt. Doing so, for the low assumption, the value actually comes up to $1,220.87. For the median assumption, we get $1,425.78, and for the high assumption, we get $1,656.71. Now we would like to add a margin of safety because we just want to make sure that we don't overpay for something even more, right? The more margin of safety we get, the better returns we're going to get in the future, because the more you pay for something today, the less gains you will have in the future. So the less you pay today, the more gains you'll have in the future. It just makes sense. Now, we're going to do a margin of safety of 5, 10, and 50%. So for the low assumption, we would like to buy between $1,037 all the way up to $1,159. For the median assumption, we would like to buy between $1,211 all the way up to $1,354. And for the high assumption, we would like to buy between $1,408 to $1,573. Guys, the current share price is $2,960. So this is very much overpriced. However, as y'all saw at the beginning of the video, they are going to have a massive stock split of 20 to 1. Now, for all of those of you guys who don't know what this means, all this means is that they are going to take their share price. They're going to take this $2,960 and they're going to slash it by 20. And at the same time, simultaneously, they're going to multiply their shares outstanding by 20. Essentially, reducing this price, but multiplying the number of shares outstanding by the same multiple, meaning that nothing really changes. But it's going to give the perception of the company actually being cheaper, which, let's face it, guys, looking at this number, essentially $3,000, is a really big mind obstacle for people who aren't millionaires, or even like for people who work on 9 to 5, right? This is really, really difficult for somebody to put in $3,000 for a company like this. So this does have a psychological aspect to it. But in reality, when they do the stock split, nothing's going to change. Now, what I would like to do is, I'm going to take this share price and I'm going to divide it by 20. And I'm going to take the current shares outstanding, which as I said, if they're not correct, I'm going to multiply by 20. And in doing so, we are going to see what these target share prices are actually going to end up being after this stock split. Alright, and now after doing this 20-to-1 stock split, so again, all I did was I took the current share price, divided it by 20, and then I took all the shares outstanding and multiplied them by 20. And what we get, the new current share price of $148.04. Now, when it comes to the target share prices, now all of them also go down because now we have more shares outstanding. But in reality, again, nothing really changed. For the low assumption, the target share price, not adjusting for debt, comes down to $60.04. Median assumption, it is $70.29, and for the high assumption, we get $81.83. Adjusting for debt, we get $61.04. For the low assumption, median assumption, $71.29, and for the high assumption, $82.84. With the margin of safety for the low assumption, we get from $52 all the way up to $58. For the median assumption, we get $60 all the way up to $67. And for the high assumption, we get $70 all the way up to essentially $79. So nothing really changes here, guys. We still have the same ratio as we did with the $2,000 as opposed to $148. But nonetheless, this $148 now, once this stock split actually happens, this right here gives a much less psychological barrier to normal people. Would you rather see $148 to pay for something or $2,960, right? The mental barrier completely crashes when in reality, nothing really changes. This just gives the appearance of being cheap, but it actually isn't. All in all, guys, Google, massive company, pretty much has a monopoly on the internet, right? Whenever you talk to somebody and you want to find out something, you don't say Bing it, you don't say DuckDuckGo it, you just say Google it, right? Because it is what it is. It's just, they have a huge monopoly on the internet, so we expect these numbers to be big. However, we do not want to overpay for a company. And right now, according to all of these metrics, they're awesome. Don't get me wrong, they are absolutely amazing. But they are very, very expensive. And we would like for them to calm down. Now, they are a tech company, so the tech sector has been pretty much overblown out of proportion. So this means that, they need to also calm down. And personally, would I buy this? I don't necessarily know. They do have a great opportunity for growth, right? It's Google. I don't think the internet is going to go away anytime soon. But for me personally, I prefer to invest in cash flow companies. Google does not pay a dividend, unfortunately. Maybe someday they will, but unfortunately they do not. So for me, I don't necessarily know. I might end up making a growth portfolio in the future where I'm going to add Google, and other companies that don't pay a dividend, but they have a massive, massive amount of growth potential. And maybe when that day comes, maybe I'll buy into them. But for now, I'm going to stay away with this, mainly because it does not match my investing goals. Not because it's a bad company, just because I would like to invest in cash flow. But that pretty much does it for this episode. If you like, comment, subscribe, really does help with the algorithm on YouTube. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble, where you should do my stock analysis videos and crypto videos to find exclusives as well. And when it comes to YouTube and Rumble, guys, I have a Let's Play channel where I'm currently playing through Pokemon Legends Arceus. So if you would like to support me there, I would like to grow my channel. If you have kids, I try to keep it PG-13. So if you have kids, then please help me out and subscribe to that channel, right? So with that said, peace out and be on the lookout for the next stock analysis video.